the best dang dancing man there is. Patrick, you're the guy. Now go out there and get him.
Hey everybody, Johnny and the Dot back with another interview. Today I'm going to interview my finance manager, Pat. Say hi, Pat.
Hi.
We're going to ask him all the questions that people wanted to know. Tell us a little bit about yourself. Where are you from?
My name's Pat. I've been in the business for 2008, so 14 years. I started as a salesman, and enough time I just fell into the right place at the right time. Got into finance at my old dealership. Now I do a little bit of everything.
You worked here the whole time, 14 years, or?
No, I started at a Toyota dealership. Worked there a couple of years, and then I went to a Chevy dealership in Bloomsburg. I was there 10 years, and then I just came up here this past June to work with the guy that hired me back there.
Okay, so you worked with Ray previously, he was our GM. Anyway, we'll get on to the questions here. Everybody knows credit scores. Hopefully everybody knows what a credit score is. What do you consider, what does the banks consider low, middle, high?
It really changes every year or two. There's your credit score, but there's a lot that goes into banks looking at somebody as having good credit or bad credit. I've seen customers that come in that have credit scores of lower sixes, but they'll get the same approval as somebody that has an 800. So it really, I think it depends on what caused your score to get to that point. If you're paying your big bills, we call them, like your car payments, your mortgages. If you have a lower credit score because you had a medical bill that slipped through the cracks for years prior, you're not going to really get dinged for that. But typically anything above a 700 is considered good credit. Anything above 750 is excellent. And then as you go down, 650 is okay. And then the banks are shifting now to giving you a interest rate based on your score. So it starts at 600 to 650 will be a certain score, 650 to 700 will be the next tier up, a little bit lower rate. 700 to 750 is a good rate, and then anything above 750 they call it a prime.
Okay. Is there anything that people can do to raise their credit score up? It goes real simple to go down. But.
Yeah, no, it's just pay all your bills on time. They want you to have debt. It's you have to have some debt. The credit card utilization they want to be below 30%. So if you have a $10,000 credit card limit, they want you to have 30% or under. So they don't want to see a balance above $3,000. You know what I mean? So they want to see that you have available credit. But just because you have it doesn't mean you're using it all. So they want you to have, available credit, how much you have available to borrow at any point, whether it be credit cards, lines of credit. They're looking at your debt to income, based on how much you have going out a month, based on what you have bringing in, the age of your credit, how long have you had credit established, what kind of credit you have established. There's someone that has a $1,000 credit card is going to have a lower credit score than somebody that has a $100,000 mortgage. So they're looking at what type of credit you have. But the biggest thing is making payments on time. As soon as you miss a payment, payments are screwed.
Something that I learned not too long ago here is, and something that he told me is, it's better to have no credit than low credit.
No credit. Banks understand that you have, you need to start somewhere. So it's, in those instances, oftentimes, for them to not necessarily take a chance, but take a chance and lend somebody that has no credit history whatsoever. They want some money down, or if you have a co-signer available, like my dad co-signed on my first car, and then that kind of sets you off the front. But I also know not everybody has the benefit of having somebody to co-sign.
It's out there. I know it sucks to ask people, but
and banks, we have certain banks that deal with lower scores. They're going to get you on higher interest rate, but that's, you got to get back on track. And that's, I had questionable credit when I was younger, and I ended up paying 20% on a car loan. that's what you got to do. You got to show that you're back on track and paying bills, and you just work your way back up to that prime. Where you'll get those lower rates. These lower rates, who knows what they are anymore.
Okay, we'll talk about that now. So if you are watching this and you do have bad credit or low credit, sometimes you ain't gonna get the car that you want. You want a car, but you might not be able to get finance for that. So what you're looking for there is to get, and correct me if I'm wrong, so we're looking there to get is find any car that you can fit. So it might be something that you're not really that happy with, but you have to actually get this car to establish your credit, build it back up for a few years, then you can get what you want, right?
Yep.
That's the best way to go about it. What are the key areas that the banks look for when you are personally putting the application?
Looking for a loan?
Yeah.
What do they look? They're looking at a few things. When someone's buying a car, I always say there's a few factors that go into an approval and what kind of rate you get. So they're going to look at, first and foremost, your credit score.
Okay.
Then they're going to look at the age of the vehicle that you're looking to purchase.
Right.
They're going to look at how long you want to finance that for, because the interest rate for a 36-month loan is going to be lower than a 48-month loan. And as you go up, the longer the term, they increase that interest rate. But things they're looking for, on an individual basis, on your pertaining to your credit, is they want to see, like I was kind of touching on earlier, your debt to income, right? So when you're filling out a credit app, you're putting in your mortgage, and then on their side, when they pull your credit, they can see, your monthly payment on your current bills, your mortgage that you have, if you have any other car payments, credit card statements, things like that. So they'll determine how much you have outgoing, and then they're going to look and see, when you do the credit app, you're putting your income on. So they call that debt to income. So they're looking at how much money you have going out a month based on how much you have coming in. So they typically want you to be below 50%. So for instance, if they look between your mortgage, your car payment, the bills you're paying now, if they see you have $2,000 a month going out in bills, a happy place is easy to, they want to see you making, say, $4,000. They want your debt, your monthly debt, to be 50% or under your outgoing, your income. So debt to income is one. They're looking at loan to value, so a lot of banks, in an instance where you have good credit, they're looking at how much they're going to lend you based on the value of the vehicle you're looking to buy. So a lot of banks, they'll go out to, say, 125%. So say, you're buying a car for $20,000. They'll look on Kelley Blue Book. That vehicle's worth $20,000. So that's your 100% mark, the value of the vehicle. Now, if you're not putting money down, you're financing your tax and your tags. So that starts bumping you a little bit over that 100%. So that's why a lot of times you'll see people, I recommend, dealers will recommend that if you're going to put some money down, try to cover your tax and tags. That way you're not financing extra value on top of the car.
Makes sense.
What I mean? And a lot of times too, you'll see, if somebody's trading in a vehicle and they owe more money than the vehicle is currently worth, to pay that vehicle off, that'll also go into your new loan, and that'll put you over that 100% threshold too.
What does being upside down mean?
Upside down literally means, with the market these days, that might happen. If you bought a car in this last year, the market is going up and down so much. So a vehicle that, and it goes both ways. A vehicle last year that was worth $12,000 might be worth $15,000 now. Right. So the market is what determines the book value, which is what the banks determine the loan to value. So as the market goes, so does the loan to value. So, but if you're upside down, it just means you're trading a vehicle that maybe you financed and you didn't put any money down. So you had your tax and tags there, and then a year later, something happened, you need a bigger vehicle. And now what you owe the bank might be worth more than what the dealership's offering you for a trade. So that's upside down. It just means that you owe more on your current loan than the value of the vehicles, which isn't a bad thing. I'd say more often than not, at some point your loan is going to be upside down. It's not necessarily bad.
Is there a certain time frame, like year-wise, where it overcomes? Like, is that an average?
It's with simple interest loans, the amortization schedules, you're paying interest out of your monthly payment, what portion of it goes towards your principal balance as opposed to paying back that interest in the bank. And at the beginning of the loan, you're definitely paying more interest in that monthly payment than you are towards your principal. So as the loan moves on, that monthly payment, where that money goes, starts going more to the principal. So, at the beginning of your loan, you're not really chipping away at your payoff too much. You're paying a lot of interest. So the further into your loan you get, the more chance you're going to have of owning it and not being upside down.
So you're better off if you did finance everything, the taxes, that you're better off paying more on, if you can, every month.
Yeah, absolutely.
If you're able
even
to
a
do
little
that.
bit helps.
Yeah. That goes right to the principal,
Yeah,
correct?
right to the bottom line.
Okay,
Yeah.
so that's what happens. We do run into people with that are upside down quite a bit, and that's usually when they're early on in the process, like you said,
Yep.
still early within the loan, and they were paying a lot of interest. It does happen.
Yep.
It does happen. What were you saying?
That's why I always tell folks too, if they're worried about what term they want to finance the loan on the vehicle they're buying, I often recommend taking a longer term. That way you at least have a cushion. God forbid another pandemic happens or something like that.
Right.
Because you know what you can pay a month. So if you leave yourself some room, you have the option to pay that off quicker, and you're not stretching your budget too far. Stay well within your means.
So the longer term, you get a lower monthly payment.
Yeah,
you're saying,
the longer the
but
term,
you
the
can
lower.
pay. So if your monthly payment ends up being you can pay $250, but you're doing an extra year, maybe it gets you down to $200. Then you can still put that $250 on there,
That
and
extra 50
pays that
right to
payment.
the next.
Okay,
Yeah.
that makes a lot of sense. How many banks do we have access to, or you have access to?
I think we're 20 plus. There's a bank for everybody. There's credit unions. There's subprime banks. For the lower credit scores that specialize in finding ways to get those deals done. So there's a bank for every deal. There's credit unions who, if we have somebody come from out of state, we're not going to use credit union because they want to see member, residents of Pennsylvania. But yeah, there's tons of banks, and each one has their own sweet spot where they like. So that's being in the business.
So we do work through credit unions as well.
Yeah.
We have people do that side. A lot of people say they get better loans through lower interest rates through there, but sometimes you can
They
beat them other
fluctuate,
ways, right?
Yeah, with our current market, credit unions aren't the lowest.
Yeah.
It's just the way it is.
Yeah, he does an awesome job with being able to find, a lower rate for you than what you think you'd be able to get. So he knows what he's doing there. What's the average interest rate like as of today?
Gosh, it really
I know it
varies.
fluctuates a lot.
Yeah, it's depending if you're looking at a new vehicle or a used vehicle, what your credit is. It's really tough to say. These days it's tough to find an interest rate lower than 5%.
Yeah, from what I've seen so far, last quite a few customers, it's even with the 800s, it's close to hard to get 5.
Yeah.
Now, when we give numbers to people out there, we give an average thing, because we get a lot of people, we get out there and I make the deal for you and bring out the numbers. If we don't run your credit, we just give you what he considers,
The state and compliance regulations and all that, they want us to quote payments with a flat rate for everyone. So they want you to take a rolling, I think it's a 90-day average, where we had some customers, with credit that they're working on where they ended up paying, 12% interest rate, and then we have customers, that have pristine credit that left paying 5%. So they want you to present your first set of numbers with that average rate. Now, I think what right now we're using is 6.99. That's our rolling average rate. So that we need to present it like that. Once we find out some information and see your credit situation and all that, if the credit's above average, typically that'll come down. But we just do that to start because that's what the state.
So that's like a state law.
Yeah, there's a lot of compliance things. Make sure you're not discriminating and things like that.
Because I do get, we bring out the sheet to people, and of course we haven't run their credit yet, so we don't know what it is. They might have told us they have good credit or whatever, but they're seeing 7%, and if they have really good credit, they're like,
Right.
We have to explain to them all the time what that is.
Yep.
So hopefully people watching this, if they understand it, any dealership they go to, they're going to be doing the same thing. If you don't put your credit app through, you're going to get a rolling average. Doesn't mean that's exactly what your interest rate years are going to be paying.
Right.
Why does it take so long to feel like it takes
Well,
so long?
the whole process is, you or whoever gathers that information from the customer, it basically creates a credit application. Then that comes up to me, and then I have to send it out to whatever bank or banks. I shop the rate around a lot of times. It's like customers want to shop around and see prices of cars at different dealerships. Same thing with banks. I want to make sure I get you the lowest rate, so I'll try a few. So while I'm trying a few different banks, once I click submit, it goes to them, and then they'll get a notification. And they have other dealers sending them ones too. So we basically are waiting for them at that point. We're just middlemen,
Right.
the financing. So we got to wait for the person who makes that decision over on the bank side to get back to us. So that's all it is. We're just waiting for them to get back to us. And a lot of times, I'll make calls. You develop relationships with the banks. So I'll call. Try to see if I can get them to lower the rate a little bit. See if because it's all negotiation even with the banks. So that's where we work for you to try to get as low rate as possible.
So I think they're not doing anything up there, and we're waiting and waiting and waiting. It's usually because the other banks, so we send out to other banks, they have to actually look at it if they're busy. Might take them a while, and then he will try to fight for you. So he'll try to fight for you and say, hey, can we get him a little lower? You might call him, be on the phone. So they are up there working.
It's still a whole lot quicker than if a customer was to go try to get their own loan.
Right.
It's still seamless. You can do everything right at the dealership.
What else should they bring into the dealership? Make sure they have the registration.
And yeah, if you're buying a car, between us and the state, you're gonna need a driver's license, valid insurance card, and if you're trading a vehicle, that registration. That's it. Pretend you're getting pulled over. We're gonna need everything to combat.
It's just amazing how many people come here and they don't have any of that. It's one thing if you're doing an impulse buy. It's another thing if you should be in your car. We all know it should be in your car. I'm guilty of it all the time too. Wrong, old insurance
Mine's
card.
probably expired.
Yeah. But it's not a big deal. Most of the time we can get them on our phones anymore. You can send them to me. I'll print them out. But
we're here for you.
He does work with our trades as well. How do we calculate people's trade value when they do come in?
There's so many resources we have available, and there's many different books out there. There's Kelly Blue Book. There's JD Power. Used to be NADA. There's Black Book. There's Manheim. There's auctions. And depending on what vehicle it is, depends what book we look at. What books. When a customer brings in a vehicle that has 150,000 miles on it,
Right.
we got to think when we're appraising it, are we going to try to resell this vehicle on our lot? So when it's 150,000 miles, typically we're not going to try to resell it. So in that case, I would look at the auction, and it'll show me all recent transactions with that exact vehicle. And typically I'll look and see, what are those vehicles pulling at the auction right now, and I would just try to appraise it at that number, with hoping that we can just bring that trade to the auction and get out of it what we gave the customer for. If it's a newer vehicle, Kelly Blue Book will show you one value, JD Power will show you one number, Black Book will show you a different number. So I try to pick a number right in the middle of all those that is a good deal for the customer and for us. Once we recondition it, detail it, fix whatever may need fixed, and then put back out on the lot. So there's a whole lot of things that go into the trade-in value, the condition of the car,
Absolutely.
things like that.
Absolutely. Yeah. I get a lot of people that ask me that question, like where do they come up with this number from?
Yeah, the books. The books, check past transactions, things like that.
How do people get more value for their trade? What do you tell them?
Take care of your car. We're looking at a lot of things when it comes to it. We're looking at the condition of the car. Was it smoked in? Was it taken care of? How many miles are on it? Things like that. So there's a lot of factors that go into it. But if you bring in that car and the person appraising it sees that it was well taken care of, it's going to add value to it. It really does.
So we're looking at dings, paint chipping, tires. Make sure you have good tires, stuff like that, right?
Yeah.
Well, we'll end this with why should people buy from us? Do you feel?
I drive 45 minutes a day to work here. I do that because of the culture we have here. I've worked at several dealerships now, and there was good cultures there too, but the environment. You know, you spend a lot of time here. You want to enjoy the people you work with. You want to enjoy the job you do. You know, I've lost count of how many times customers have told me, you know, or anybody on our reviews. It's just, we don't pressure folks here. You know, we're here to make a living. We're here to take care of you, and we as salespeople understand that word of mouth, repeat business, referrals is everything. So, you know, we're going to make that experience as stress-free, hassle-free, you know, non-pressured. It's a good environment. You know, car dealerships have had bad names forever. Salespeople, and you know, we've flipped the script on that. We're here for you. We're not.
If you're not from Pennsylvania and you're watching this or anywhere else, you just stumbled across it. Hopefully he answered some of your questions. If you have any other questions, you can write them down in the comments. I have no problem. I'll ask Pat. He has no problem answering them for you. The culture around here is great. It's a fun time, guys, and it's the same thing for me. It's just how many customers have said to me, you know, that the atmosphere around here is so different compared to everywhere else because it's a lot more laid back. They feel comfortable. They're out there. We don't pressure anybody. Yeah. So I appreciate it, Pat. Thank you.
You're welcome. Thanks for having me.
All right, everybody. It's Johnny on the dot. Stopping by once again to give you a video with our finance manager. See you later.